The two models I mentioned earlier were about stock valuation, and if you use these valuation models, what you get is the intrinsic value for the stock price or the true price. And this is based on our theoretical approach, and that is where the equilibrium should be. However, in reality, the stock price could deviate from the intrinsic value because the investors have different perceptions about the stock market or a particular single stock, and their perception would affect the stock prices to deviate from the true value. And sometimes the stock price could become overvalued, and sometimes it could become undervalued due to irrational or wrong perception of the investors. So here we have the stock's intrinsic value determined by the true cash flows generated from the firm or the stock, and the true risk estimated according to the feature of the stock. And how to estimate the risk, it is in Chapter 6. However, in the market, the investor perception really plays a big role, not only in the perceived cash flows, but also in the perceived price. In a normal situation, intrinsic value is not quite different from a stock price, but things could happen. There could be some exceptions. And right here, I'm going to introduce you the efficient market hypothesis. This is introduced by Dr. Eugene Fama from the University of Chicago and Dr. Kenneth French from the University of Dartmouth. And this model helped Dr. Fama won the Nobel Economic Prize in 2015. So in this model, we see that the market efficiency is a hypothesis. So what does market efficiency mean? That means the stock price reflects all available information, and this information would be called material information that is related with firm's earnings and the risk level. If anybody have a material information, and your decision would be different if you have more or less material information. If you have a positive information like good earnings for the year, then investors would buy the stock, so there would be a lot of buy orders in the market. The stock price would increase. If there is a negative information like financial scandal of the firm, then people would dump the stocks, sell them, the price would decline. So that's pretty straightforward. And an efficient market basically means the price reflects all the information, positive, negative. And we can possibly have a perfectly efficient market. And in this perfectly efficient market, no information advantage of any traders over another group of traders. So basically that means everybody knows everything. And then the stock price will be at the right amount. It will be right there at the intrinsic value. So the buyers pay a fair price for the stock, the sellers or the firms receive a fair value for their securities. However, perception matters. Like right here, I'm not sure if you guys watch the European Cup. When the soccer star, he is one of the highest paid soccer star, Cristiano Ronaldo, removed Coca-Cola bottles from his desk in a press conference after a game, the Coca-Cola stock price plummeted by certain percentage. Do you think such a move would affect Coca-Cola's earnings of the year? A little bit, maybe not, but it's really investors' perception about Coca-Cola that change the stock price in such a short amount of time. And in the efficient market hypothesis, if new information arrives, prices would move to the new equilibrium very, very quickly because there are so many smart traders and smart analysts looking for mispriced securities. If the securities are overvalued, they would sell the security or short sell the security. If the stock price is undervalued, then they would buy the stock and make the stock price increase. so the price would get back to the right level. And that means the mispricing of either overvaluation or undervaluation will be immediately corrected. Now let's look at what types of information all these smart traders use. One type of information is called historical prices. So you just look at the past performance of the stock. This is the stock price this is the price chart for Google. As you can see, the price level just fluctuates, and the normal trend is going up. So if you look at stock prices, you would need to detect the trend and also the cyclical patterns. Fictitiously, if you look at a stock price performance like this, then you know it's going up and going down and has a upward trending. So what would you do? You could be a momentum trader in the long run, because over a longer time period in the past, the stock price is going up. So we assume the stock price will keep going up in the future. If you're a momentum trader, then you would buy the stock because you assume the stock price is going up. But if you trade for short term, as you can see, the stock just reached another new peak. So it could go down in a very short amount of time. Then you, instead of buying the stock, you would trade against the current trend. You see the current trend is going up, but you would sell the stock because you think it will go down in the short run. And in that case, you are a contrarian trader. Another type of information is public information issued by the companies, the press, and even the government. So you can check the company's financial statements. You can also watch the news for the merger and acquisition, all these events, and also the new release of a product by a company. So this would definitely affect stock prices. And another type of information is called insider information. And if you know insider information, believe me, you can still make a profit. However, that insider trading is illegal. If you conduct insider trading, then you will violate the law and you could be arrested for that. This person is Mr. Ratnam. He was the head of a hedge fund called a Gallon hedge fund, and he conducted a lot of insider trading at that time. And insider trading, of course, you need to have somebody, some friends that has insider information. They could be manager at higher level, or the press, some journalist, or the government that has connection with the companies. What this person did was he had an insider friend called Gupta. He was a Goldman board member, and he tells this Mr. Ratnam that Warren Buffett will invest $5 billion in Goldman. That is a positive information. When the market learns about it, the price will go up. And he learned this before the market knows it, before the public announcement. He learned it from his insider friend, and he purchased the stock before the announcement of this information. And when the next day Warren Buffett made the announcement, the share price jumps and he made a profit. And another case is about selling the shares. Still, the same insider friend tells Mr. Raj that the company's earning is pretty low, so he just sell. So Mr. Raj receive this negative information and then just sell the stock before the market learns about it. So he avoid losses. So selling by insider information is just as bad as buying on insider information. So the lesson here is don't do it. We're in Chicago, and there are a lot of public traded companies in Chicago, and you may have a lot of friends or relatives in Chicago, and you will come across with certain conversations about their companies. So if you hear about some insider information, you should not trade on them. It's okay to have fun with them, to have discussion with them, but you just cannot trade their stocks, their company's stocks, based on the insider information you received. Here is one trading technique called short selling. It is the way to profit from stock decline. Short selling in the security market is different than short selling in the real estate market. If you do a short sale in the real estate market, that means you are selling your house below the value of your mortgage. But in the stock market or bond market or even futures market, short selling means completely different things. If you do a short selling, you borrow the securities, for example, the shares of stocks from a broker today, and then you sell it right away for cash. So today you have a cash inflow. And later on, you need to return the shares to the broker you borrowed from, and you are going to buy the shares from the market and then return the share to the broker. By doing this, you hope that today the stock price is higher than the price later. That way, you can receive more cash flows today and spend less cash flow to buy the stock later. So this is how you profit from the price decline. And of course, if a price later gets higher than today, then you would have a loss. You probably have heard about the recent stock frenzy about GameStop. So GameStop is a company that didn't do very well during the pandemic, and the Wall Street expect the stock price to decline in the future. And they have solid information supporting that expectation. If you check GameStop's financial statements, and they did not do very well, their profit became negative over a quite long period. So definitely this is a stock that will become less valuable. So what the Wall Streeters did was they short sell the stock, and they also make announcement of their position that they have short sold the stocks. The Wall Streeters were thinking that if everybody knows this stock sucks, then they will all sell it, so the price would decline more, and then as short seller, they can profit more. So that's their plan. However, there are a group of people that are against the Wall Streeters. From this chart, you can read this chart when you have some time. So what happens here is they basically a group of individual investors against the Wall Street people organize together, and then they keep buying the stock shares. So when the individual investors buy the shares, and this is a small stock, so it doesn't take billions and billions of dollars to make the price change. So that is a loss for the short sellers. And the more the stocks the individuals are buying, the retail people are buying either using Robinhood or E-Trade, and they are organized through social media called Reddit. These are all Reddit users that are against the Wall Street people. So the short sellers eventually abandon their position, facing the potential losses, and when they clear their short position, they have to buy back the shares and return to the brokers they borrowed from. But it's hard for them because the price just became so high. So they have to eat the losses. But of course, such behavior by the Reddit users lack financial fundamentals. It's more like a market manipulation, or it's more like the common villagers storm the castle or a communist revolution. There is no financial foundations behind that. So when the stock price ballooned from $20 to $350, then it tumbled right after because the perceived price, the market price, just deviated too much from the intrinsic value of the stock, and then it will get back to normal. And this could be suspected for market manipulation behavior, and what the Reddit user did and their leader were suspected by the Securities Exchange Commission for manipulative trading behavior. And this example is a good example to show you how the market price based on investor perception would deviate from its intrinsic value. It could also show you how the short sellers profit. Actually, in this case, they lost, the stock price goes up. At last, we want to know, why do we buy stocks? If you look at a stock 100 years ago, it's a stock certificate. It doesn't have a due date, and you can receive cash flows from it, or